Coming up on the SBS On The Money podcast, inflation re-accelerates, why Donald Trump wants Greenland, and we focus in on gold. That's all next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 8th of January 2025. The Australian share market rose today, up by 0.8%. We'll have the details along with opportunities for investors on the share market with Mathan Somasundaram from Deep Data Analytics at the end of the podcast. But first to today's inflation numbers, the monthly CPI indicator, an annual rate rising from 2.1% to 2.3% in November, but the underlying rate fell from 3.5% to 3.2%. It's still above the RBA's target of 2 to 3% though. So is this good news, and what does it mean for interest rates? For that and more, I spoke with Paul Bloxham, the chief economist at HSBC. Paul, how would you describe the inflationary environment in Australia at the moment? Is it moving in the right direction?
It is. It's moving in the right direction. The economy is gradually disinflating, and that's what these numbers today told us, that inflation's gradually coming down. Now, keep in mind, of course, you've got to keep a really close eye on the underlying measures, the trimmed mean measure in this print, because the headline measure has been really affected by all those government subsidies. But even that measure, the underlying measure, the trimmed mean, it's showing that it's gradually edging lower. We're not out of the woods yet. It's not back in the RBA's target band. It's still a bit too high, but we are heading in the right direction.
Are there any sticky points, though? We constantly talk, for example, about services inflation remaining sticky. What about it and other concerns?
Well, that's certainly a part of the story still, and it's certainly part of the story of the numbers today. You know, the things that contributed the most to the inflation print that we had were things like rents and education. And so it is those sticky parts of inflation, the services bits of inflation, that are still holding up that are at rates that are a bit high for the RBA, and one of the reasons why we're still reluctant to think the RBA is going to be cutting quite yet.
It's not the only piece of data out today. Before we talk about the RBA, we saw jobs vacancies from the ABS as well, up 4.2% in Q4. It's the first rise in over 2 years. What does that say about the economic environment?
Well, at the first pass, it's actually another part of that good story. Inflation's coming down gradually. It's not quite where it needs to be, but it is coming down. But at the same time, that is happening while the economy is still close to full employment. If you remember, just before Christmas, we got an unemployment print that fell. We saw the unemployment rate tick lower, and now we're getting other indicators, like you say, the job vacancy numbers, which are actually rising for the first time in a bit over 2 years. They're saying that the labour market is actually quite strong, that the jobs market's still quite strong. So the fact that we've got inflation coming down and a jobs market that looks as though it might even be tightening is a positive thing, although, of course, it has implications for the RBA as well.
Yeah, can we go into more detail? So put all of that combined, what are the implications for the Reserve Bank? Because, you know, the consensus seems to be that we'll get a rate cut this year. It's just a matter of when.
Well, that's right. And that's our central case as well. We think that the RBA will be able to deliver rate cuts this year. We don't think they're going to be convinced, though, by the time we get to the February meeting. We think inflation's still proving to be sticky and falling a bit too gradually, and the labour market, of course, tightening up is something a little bit surprising. They really didn't expect that. And so we think that combination will mean that they won't likely cut their policy rate in February, but we do have in mind that we might get a rate cut by around the middle of the year, the second quarter of this year. Now, that said, if inflation continues to fall very gradually, and if the labour market actually continues to tighten up, there is still some risk out there, and we've been talking about this actively, certainly through the latter part of last year. There's still some risk that the RBA may not be able to cut even that soon, and may not be able to cut at all. They may miss the easing phase altogether. So, you know, there's good news in this, in the sense that inflation's coming down, and there's good news that the labour market's still quite strong. But the challenge here is all of that added together means that the RBA, rate cuts are still probably some time away. And it's possible that actually we don't end up getting rate cuts because, well, the RBA didn't lift rates as much as everyone else. We haven't had as big a downturn as elsewhere. We haven't had as fast a disinflationary process.
That's Paul Bloxham there, chief economist at HSBC.
Now, Market Day on the SBS On The Money podcast.
It was a good day for the Australian share market, up by 0.77% on the S&P ASX 200, closing at 8,349. The likes of the Commonwealth Bank doing well, hitting a record today. With more market action, including the opportunities for investors, I spoke with Mathan Somasundaram from Deep Data Analytics. Mathan, first of all, how did the market react to today's inflation update, and what are the implications for interest rates?
Yeah, it's an interesting one because it's a monthly CPI. So this is affected by the government handout. So generally, it's not something that is going to change RBA's minds. But the important part is it's beaten expectations and it's rising, which is a common trend we're seeing. We had EU inflation come out overnight. And again, it was as expected, but it's rising. And we've seen that in the US. We're seeing it around the world. Inflation is picking up. And for us, the bigger issue is the currency has fallen quite a bit, and I suspect that's going to keep falling. So that'll add to the inflationary pressures. And you can see in the US, the 30-year bond yield is now multi-year highs. The bond market is not buying the spin the central banks are pushing. So I think it makes it even harder for RBA to cut. I don't think they were going to cut. I think the political pressure was put on, but I think the data is just not there. I mean, if they cut now, they will lose any amount of credibility that they've built up by just holding. They didn't go high enough. They didn't get the effect that they should have got. So now they're stuck on hold for a lot longer.
We talk about Donald Trump now. We're getting closer to his inauguration. Will his leadership change the way you invest or the outlook for shares? And I mean, every day we seem to hear about some new interesting story. For example, today, a Greenland-focused mining company in Australia called Energy Transition Minerals surged almost 40% its share price today after Trump suggested a US takeover of Greenland was not out of the question.
Yeah, the only thing that's not out of the question is we're going to have sanity for the next 4 years. Look, the reality is US is not going to take Greenland. US is not going to take Canada. US is not going to take over UK. And Panama Canal is not going to be sold to US. They're not going to take it by force. That's just not going to happen. Look, you never say never. There's probably a 5% probability, but the reality is that's just not the probability event. Why are they looking at Greenland? For the obvious reason that when they go into a trade war, rare earth and critical minerals are going to be harder to get because China will restrict it. Greenland has a lot of rare earth. So it doesn't take genius that there's a lot of tech billionaires backing Trump, and they would have all said this is a worthwhile thing. Now, will there be more mining in Greenland? Yes. But is that going to take a long time? Yes. But is that going to be anything that's going to suddenly change over the next couple of years? No. So this is really a distraction, because at the end of the day, the US policy changes that are going to come through will dramatically increase the debt and the interest cost on the budget. So we need distractions. So all of these things are just pure distractions. The reality of it is, I mean, just imagine the fiscal problem that Canada has, the fiscal problems that UK has. You think America wants to add that to their own existing stretch balance sheet? No. So these are all, I mean, Panama Canal is just because the fees through Panama Canal has gone up. That's mainly because of a climate change. So really, there's not a real reason what they're talking about, but these are all distractions in the short term.
Okay, the other thing I've noticed is that gold jumped overnight, supporting gold stocks. What's your take?
Yeah, look, we have been in a bull market for gold for a while now. We've been there since probably late 2019, and we don't really see a reason why you should be getting out of that sector. Inflation is going up. Central banks are not going to fight it because at the end of the day, there's no political capital to fight inflation. So there's a real risk that we will repeat the cycle of 1970s, and we'll have multiple inflation cycles. They will say it's transitory because they just can't do anything. The economy is too weak because they didn't do the right thing. We had probably at the end of last year was the deadline for central banks to get off stimulus and tighten quite a bit because the political cycle kicks in. So now we have a political cycle. So everyone's got election cycles. Incumbent governments are getting kicked out. mainly because the public is basically blaming them for the inflation cycle which played out. So I think that's the main trend here. So that's going to play out well for gold. I think central banks will basically sit there, watch inflation go up, and in some cases may even cut despite that making it worse. So that's why gold is in a good place. And we prefer Aussie gold miners simply because Aussie dollar is falling. So, Aussie dollar spot gold is over 4,000. I mean, I think it's near 4,200. Most people's cost base is around 2,000. So you're looking at 100% profit margin. Yes, they do have operational risk, as with any mining stock, but Aussie gold miners don't have sovereign risk, have a huge margin. What's not to like?
So you've mentioned gold there. Where else do you see opportunities for investors?
So we basically targeted inflation sectors. So we're long inflation sectors, short consumer spending sectors. So that's our thematic, has been for a while, and it's playing out. Despite the US Fed cutting 100 basis points, bond yields are up 100 basis points. So your mortgage is up 100 basis points. So the reality is consumers are going to continue to struggle. In Australia, we have per capita recession, which means more than half the population is in recession. Whatever the spin may be, that is the actual data. Then on top of that, so what do you want to play in? Well, energy was the only sector that was in value territory. It's bouncing. Oil price is now $74 in US dollars. And I suspect that's going to go higher. We've got really cold weather coming into US. Gas prices are at multi-year highs in the US. And, apart from Western Australia, everyone else pays global prices. Guess what? Our gas prices are going higher. And so a lot of the energy stocks should be doing a lot better, and we're long in that sector. The other sector we like in a similar thematic is food. Food prices are a lot higher. They have bounced off the bottom, and the climate change risk is reducing supply around the world. So in theory, food prices should be doing well. And, if you look at in our market, things like the basic producers, like, if you look at milk, you look at Fonterra, it's doubled in the last year and a half. If you look at Sunrise, basically makes rice, nothing's fancy, and it's pretty much up 50% in the last year and a half. So basic food producers are doing well, and I suspect the agri sector is going to do quite well. Yes, they'll be volatile, but the regional Australia is doing well, agri sector is doing well. And it's inevitable that there will be a trade war between China and US. Generally, the reaction from China will be to cut out US farming products, which means the rest of the world will see a bump up, and Australia should benefit from that. There's a reason why China removed restrictions on beef, etc. So, be long agri sector. You can't fight the stupidity in the world, but you can benefit from it.
That is Mathan Somasundaram there from Deep Data Analytics. Don't forget, if you enjoy the podcast, to give it a rating on Apple Podcasts and Spotify, and to click that subscribe button.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.